How emotions control trading decisions. Trading is often presented as a game of numbers, charts, and strategies, but beneath every trade lies something far more powerful than any indicator: human emotion. The truth is, markets move on logic, but traders act on feelings. Fear, greed, hope, regret, and overconfidence quietly influence decisions long before the buy or sell button is pressed. Understanding how emotions control trading decisions is not optional. It is essential for survival in the market. Every trader begins with optimism. The charts look simple, profits seem achievable, and success feels close. At this stage, emotions are subtle. Confidence is high, caution is low, and risk often feels smaller than it truly is. This early confidence can be dangerous because it creates the illusion of control. When a trade goes well, the mind attributes success to skill. When it fails, it blames bad luck. This imbalance sets the foundation for emotional trading. Fear is usually the first strong emotion traders encounter. Fear appears in many forms: fear of losing money, fear of being wrong, fear of missing out, and fear of giving back profits. Fear causes traders to exit winning trades too early, cut profits short, and hesitate when valid opportunities appear. A trader may see a perfect setup, but fear whispers doubts. What if this one fails? As a result, the trader stays out, only to watch the market move exactly as expected. Over time, fear trains the trader to distrust their own analysis. Fear also intensifies after losses. One losing trade can emotionally outweigh several winning ones. After a loss, traders often reduce position size too much, skip trades, or close positions at the smallest sign of pullback. This behavior is not based on strategy, it is based on emotional pain avoidance. The market becomes threatening rather than neutral, and the trader begins reacting instead of executing. Greed is fear's opposite, yet it is equally destructive. Greed convinces traders that more is never enough. A profitable trade suddenly feels incomplete, and instead of following the plan, the trader holds longer, increases risk, or removes stop losses. Greed creates the fantasy of perfect trades, buying the exact bottom and selling the exact top. When greed takes control, discipline disappears. Greed often shows itself after a series of wins. Confidence turns into overconfidence, and overconfidence leads to rule breaking. The trader begins to believe they have figured out the market. Risk increases, patience decreases, and losses that were once manageable become devastating. Greed doesn't feel dangerous in the moment, it feels exciting. That is why it is so hard to detect. Hope is another powerful emotion that quietly destroys accounts. Hope convinces traders to hold losing positions far longer than planned. Instead of accepting a small loss, the trader waits, believing the market will turn around. Hope replaces logic. Stop losses are ignored, targets are moved, and the trader becomes emotionally attached to being right. The market, however, does not reward hope, it rewards discipline. Closely tied to hope is denial. Denial allows traders to ignore clear signals that a trade is failing. Indicators are reinterpreted, time frames are changed, and new reasons are invented to justify staying in the trade. At this stage, the trader is no longer trading the market, they are trading their emotions. Revenge trading is one of the most destructive emotional behaviors. After a loss, especially an unexpected one, the mind seeks immediate relief. The trader feels an urge to make the money back. This urgency leads to impulsive trades, poor setups, and excessive risk. Revenge trading is driven by anger and frustration, not opportunity. Instead of slowing down, the trader speeds up, and the damage compounds quickly. Another overlooked emotion is boredom. Markets do not always move, but traders often feel the need to act. Boredom leads to overtrading, forcing setups that do not exist, and trading without a clear edge. These trades are rarely part of a plan. They are emotional responses to inactivity. Ironically, some of the best trading decisions are decisions not to trade at all. Regret also plays a major role in trading psychology. Regret appears after missed opportunities and poor exits. Traders replay charts in their minds, imagining how much they could have made. This emotional replay leads to chasing trades, entering late, or abandoning rules to avoid feeling regret again. The market then punishes impulsive behavior, reinforcing the emotional cycle. Overconfidence deserves special attention. While confidence is necessary for execution, overconfidence blinds traders to risk. It creates selective vision. Only confirming information is noticed, while warning signs are ignored. Overconfident traders stop reviewing mistakes, stop journaling, and stop improving. The market eventually humbles everyone, and overconfidence often leads to the largest losses. What makes emotional trading so dangerous is that emotions feel logical in the moment. Every emotional decision can be justified with a story. The problem is not emotion itself. Emotion is human. The problem is allowing emotion to override structure, rules, and probability. Professional traders are not emotionless. They feel fear, greed, and doubt just like everyone else. The difference is not emotional absence, but emotional control. They operate with predefined rules, strict risk management, and acceptance of uncertainty. They understand that losses are part of the game, not personal failures. The key to emotional control is awareness. A trader must learn to observe emotions without acting on them. This begins with preparation. A clear trading plan removes decision-making during live trades. Risk management limits emotional damage. Journaling exposes emotional patterns over time. Acceptance is another crucial skill. Accepting losses, missed trades, and imperfect executions reduces emotional intensity. The goal is not to win every trade, but to execute consistently. When execution becomes the focus, emotional pressure decreases. Time also plays a role. Emotional control develops with experience, but only if the trader reflects and adapts. Repeating emotional mistakes without awareness leads to burnout. Learning from them builds resilience. Ultimately, trading is not a battle against the market. It is a battle within the mind. Charts reveal price, but behavior reveals character. Those who master their emotions gain clarity. Those who do not remain trapped in cycles of fear and greed. Success in trading does not come from predicting the market. It comes from managing yourself within it. When emotions are controlled, decisions become clearer, risk becomes manageable, and consistency becomes possible. This is the real edge, one that cannot be found on any chart.